This week, we are lucky to have Noah Rosenblatt with us from UrbanDigs. Noah's been, a leading expert on the data of what's going on in the New York City market in general. Specifically, he's been talking to COVID and how that's affecting things. So very excited to just have a conversation with Noah about the New York City real estate market.
Yeah, man, it's great to be here. Thanks for having me.
Of course. So the world has opened up a little bit now, right?
Yeah.
New York City, since it's a month today, right? Today's the 22nd. So a month ago today,
yeah,
New York City opened. What are you seeing from your perspective to date?
Well, there's a lot of things going on. The one thing I think that's popping out is it's almost like we're starting an active season and we're consolidating, a few months into one, So like, for example, what usually happens in February, March, and April when it comes to new listings? They usually rise, right? Every year is the same thing, right? February, March, April, a lot of stuff comes on the market. What happens with contract signs? They start to rise. They start low and then they kind of build up, and they usually peak out in May, June. That's a typical active season. Now, obviously, we did not have an active season. We had a lost season, a dislocated system with COVID. Now we're reopened. I'm looking at some of the stats right now. Over the last 30 days, we brought 2,250 listings on the market. So how much do we usually bring on the market? 1,500, 1,400, 1,600, and this is rising. So we don't know how much it's going to peak out. So it's almost like you got like a February and a half of March combined into one for the month of July in terms of the activity on the active side. When I look on the contract sign side, that's a completely different story. We're kind of at the 400 level. That's creeping up. But that's numbers that are just not representative of an active season market. So you have new listing inventory that's starting to look like a very aggressive active season, new listing season. And that's obviously because everyone was waiting to put listings on for the reopen. And that's happening right now. So the question is, does that continue? Right? If we see next month another 2,200 listings come on, and then next month another 2,200 listings come on, you might see inventory near 9,000 or 10,000, which is levels we haven't seen before. And it's not a function of normal market dynamics. It's more of a function of COVID market dynamics, where you had this 4-month shutdown period. Now it ended, and now whoever may have wanted to list during those 4 months is now coming to market. So
it's just interesting, right? Because you're interpreting the data that we're seeing, right? And then
I'm trying to.
As a real estate professional, I'm there to advise clients as best as possible as to where I see the market, what should they be doing. And it's just a hard thing to answer right now. I have buyers. Yeah. I have buyers that are saying to me, well, if there's going to be more and more inventory, why am I going to buy right now? Why don't I wait and see what's going to happen and then go after it? I have other buyers that are saying to me, yes, there may be more inventory that's going to come on the market. However, I believe I can get a really, really good value play right now. So I'm going to do it now. How do you? They're
both right. They're both completely right. The value play is still in there. The big confusion on the value play is that buyers can't expect to get the types of gap down bids hit like that happened in the shutdown, especially when there was high fear levels in March, April, and May than today. So what's going to happen is you're going to have some confusion. You're going to have some confusion because the COVID sales are going to start filing in. Naturally, you'll probably start to see a rise in listing discount trends, and you're going to see a fall in price per square foot and median sale trends. We don't know what those numbers or extremes are going to be yet, but that's going to be representative of a past market. And now the numbers come to light, and the buyers are naturally going to think, okay, this is what's going on today right now. And that's not the case. So number one, buyers just need to understand value. Yeah, you can get value. But if you're going to put down a 20% below bid, a 20% below ask bid, and expect the seller to just hit that out of fear, those are very, very, very few and far between. And quite frankly, they were few and far between during the shutdown. That's why we had no volume. We had very wide spreads. So now it's just a matter of both of the buyer and seller kind of understanding. It's like, all right, today's market is difficult. It's challenging, but it should be at a level that's a few notches higher than where we were during the shutdown period with higher levels of fear. And that's where the price discovery is going to start to come in, right? The other buyer what was the other buyer that you said? To wait because of inventory.
Right.
I mean, here's the thing. Yeah, you can wait, but I mean, I think most of it's going to be done in 2-3 months. We're already 1 month into it. So like, if you think about a typical active season, right? Think about a buyer in February. No one would buy in February if they're like, well, active season, what about all the stuff coming on in March, April, and May? My answer would be, well, if you find a property that meets your needs, and I assume you've been looking and you're aware of product knowledge and what's out there, you know as well as I do, Russ, that the first 20 seconds when you go into that property, buyers tend to have that sense of whether or not it meets their needs. And more importantly, whether or not it doesn't meet their needs. They'll know in the first 15, 20 seconds, something's not right about this property. Same thing with the if they like the property, they get that feeling. So, I mean, if you get that, I mean, and you have a good deal, potential good deal to get, and you're even negotiating even better deal right now, I would not delay that decision just because of inventory that you think is going to come on in the next 2 months that may or may not be better than that place.
I don't think that's the only consideration. I think it's also, okay, well, what if there's a double dip in COVID? What if the restrictions tighten again and, we can't show real estate? Will that same opportunity that was available in March and April be available again in November and December? Those are the kind of things that I'm hearing. Why they're
deflationary, depreciating asset type of things. It's going to go down again. I mean, my answer is I think those forces are being priced in today. I think bids are constantly trying to price in not only where prices are now, but where they think prices are actually headed. I mean, if you recall, the price trends are rising right now. I mean, not real time, right? Because we wait a couple of months on UrbanDigs for all the files to come in, right? Which we're going to change. We're going to actually give people access to those recent numbers, even though they're incomplete and they're going to be more volatile. But we still had a good market in November, December, January, February, kind of going into COVID. And those sales are kind of showing in the March, April, May numbers. They're showing June numbers. They're showing a little bit of increase. They're not showing COVID yet. So how much are we down from those levels in COVID? The answer is we don't know. Like, that's about to start. I kept saying, wait until July, August, September, October. Those 4 months, somewhere in there, we should get the COVID extremes coming out, right? Now, I would think that buyers are pricing that in. And again, those deals that are signed COVID that are ultimately going to power the sales in July, August, and December, those are done deals at this point. Those are going to be down. That's where buyers were pricing that stuff in. In terms of a double dip, I think you're just going to have a situation where sellers are going to be balking at bids that are just too low, that are pricing in too much of things that didn't happen yet. Because you got two things going on here, right? You got massive deflationary forces. No one's denying that. I've been saying that since the beginning. Usually that's the most powerful force, massive deflationary forces, right? And then that's being counteracted by massive fiscal and monetary stimulus, which you're seeing. And we're about to get another fiscal round. That's pushing up stock markets and risk assets. It's almost giving the impression that maybe the recession won't be as bad or whatever.
Is there a segment of the market that you see performing better than other segments? The Upper East Side 3-bedroom co-op market versus the condo, in the financial district?
Yeah, I haven't really broken down and checked that, only because I'm just starting to get back into things. I will tell you that it's very clear that the lower end price points are most of the activity right now. So I would think those 3-bedroom co-ops in the Upper West Side are not really moving, even though that was a strong sector pre-COVID. I would think it's down notably from where we were, just on that level.
It's interesting. I've been working with some buyers on the Upper West Side, for a townhome. Mm-hmm. And although pricing didn't necessarily jump up, there was a lot more activity than there had been, right? Because I think people want that space and outdoor space and, the privacy of having their own, their own home, that kind of thing.
Yeah. Upper West Side Market Pulse, and you know that number, right? It was at 0.8 or so before this all started, which is a very strong reading. I believe the market was at like 0.4 or something like that.
So just explain exactly what that means.
It's a ratio of supply and demand. It's a ratio of how much inventory you got based on how much is in contract. So if you think about it, if you have a market that has 1,000 listings for sale, and you have a listing, and then you have 200 in contract, so for sales up here and contract signs down there, it would be 1/5. 1/5 of inventory is in contract, so it's 0.20. It's 20%. And the idea is the lower the number means the weaker the market, the more the distortion towards the inventory side. There's more inventory than there is demand. And the higher the number is, the stronger the number. That means that you have 1,000 in contract and you have 1,000 for sale. So that's a strong market. You got them almost in equilibrium. This was at 0.8, which means you got 1,000 for sale and you got 800 in contract, which again is a strong number. And I like to do this relative to other sectors. So you could see how the Upper West Side is doing versus, like you said, Tribeca or the financial district, condo sector. You could do all this on UrbanDigs. And I'm looking at it, and right now it's down to 0.25, straight cliff dive.
Yeah.
So, and again, I think about the Upper West Side co-op sector, and it's probably higher price points. In every down cycle, you typically see the same thing. 2 million and below will be those outperformers, and they're going to start to come back. Sometimes you see the high end come back first in down cycles, like the luxury sector will get hit first, and the luxury sector will come out first. That happens a lot. But like we're not coming out of anything right now. Like pending sales is trying to find a bottom.
So what do you say to a seller? What do you say to a seller that has a $3, $5, $7 million apartment that they want to sell? What do you say to them right now?
You got to manage your expectations accordingly, because who's buying $7 million properties right now? Who's putting that kind of money to work? Like again, in times of uncertainty, in times of deflationary forces, those higher price points tend to get hit, and they tend to see lower volume. And this is all about liquidity. So like the question is, my first question is, well, how what's your need to sell? Do you have to sell? Is there a margin call here? Is there a liquidity event going on? I mean, do I have 6 months or 8 months to do this thing? And if the answer to that is I need to sell, then you gotta truly understand where that market is, and price discovery right now is not an easy thing to do. The best thing you can do, because if you have a $5 or $7 million apartment, it's not like there's going to be 20 places to have as comps. You know what I'm saying? First off, you're going to have a lot of uniqueness to that apartment. It's probably very different. Probably got some rare features to it, which now you're going to go out there and try to find something comparable, something similar that has the same features and uniqueness to that, which is going to be difficult to find. And then you're going to have to say, all right, well, how many closed? And I'm going to be like, all right, well, Acris stopped filing for 4 months. They just started filing sales. So that's going to be a problem in terms of finding some good closed recent comps. And then I'm going to say, all right, well, look in contract. All right, so what's in contract? 2 things, 3 things. One of them may be good. You got to contact that broker and find out what's going on. What kind of intel can you get in terms of where that deal happened? And then you got to go and say, how is this place different? Am I bigger? Am I smaller? Do I have a better view, a worse view? Am I more renovated, less renovated? And adjust according to that number. You know what I'm saying? That's the best you can do.
You're right. It's such a unique spot to be in right now.
The market.
Getting the data to comp is so hard.
Because there's no market. I mean, there is a market, but it's a dislocated market. It's not a market as we think a market is. So again, you don't know where. It's all about the bids. The market at all times is all about the bids. It's about the buyers. It's about the bids. It's what somebody is willing and able to pay for, that a bank is willing and able to match and appraise and fund. That's really the 2 things that you have to worry about. And a co-op board, I guess, has to approve, because some co-op boards will not approve 25%, 30% sales down. They'll just skip it out and reject it.
So switching gears for a second, what are your thoughts around this idea that there's this exodus from Manhattan, that people are going to be leaving these urban areas because of the fear of being inside due to a future pandemic and other forces of nature? What are your thoughts around this concept?
Yeah, that's a real thing. I will admit that my initial impression of it back in March, April, May, when this talk started happening is, we're in the midst of a shutdown where the government is literally shutting us down. We cannot work. Everyone left. Everyone's trying to do their business in another area. Of course, we're going to hear this kind of talk. I mean, let's think about where we are in a year from now. Okay, things have changed a little. With the whole defunding the police, there's been a little more social unrest, not so much in New York, but in other areas. How is this changing psychology for urban cities? This is a question you got to ask. Is crime changing? I just took a quick look at crime statistics. It actually is mixed. So you have a lot of areas that are down, but then you got some areas that are up, but it's not like it's surging. There's just some categories that are up a little bit, but a lot of areas are down. Is that something that's now on a change? These are things I ask myself, and these are things I look at. And as long as crime does not go out of control and does not reverse the trend that it's been in, and people feel safe. I mean, that's your biggest risk, is you don't want people in New York City feeling unsafe. Okay. And you don't want them saying, I can't go outside at night. I can't walk around, because dealing with boarded up retail and no commercial and all that's two other things that you got to deal with. Like, in those respects, I think it's a moment in time. I think it's a moment in time. At some point, you will see those boards come down, and it's already starting to come down. Like Madison Avenue in 50s and 60s and 70s, all those were boarded up. That's now coming down. So like that moment in time is starting to pass. Commercial buildings, that's its own kind of thing. So I think that it's a real thing. It's a real thing, but we're also in the middle of a generational type pandemic that no one's experienced before. New York was the first one hit. We were the first hotspot. Of course, you're going to have this kind of talk. And of course, it's not going to go away. Now, where is this going to be in 2 years? This is how I try to think. In 3 years, my answer is I think New York City will be fine. I think New York City will be fine. But I think this is one of the forces, one of the deflationary forces that's kind of impacting the market right now. More so for commercial, less so for residential. I think commercial's in its own little problems. I don't know what's going to happen there. But residential, I think it's being priced in. It's one of a dozen things that buyers are trying to put in their head to bid appropriately and price in. And again, we still don't know where that level is yet because of the lag in sales. The sales that Acris is filing is just starting to get into that COVID timeframe.
Yeah, it's going to be interesting to see how it shakes.
Yeah.
Okay, what else is interesting, do you think, for our people out there to know about where your head's at with this whole thing?
Yeah, one thing I thought about today, I'm trying to think of a narratives and message for agents to relay to clients. I'm constantly trying to interpret data and think about what the current message is. That's like my job now. And I thought of something this morning I thought was interesting. I got to go put more time into it, but I would be keeping an eye on listing discount. And again, we're going to launch a feature on UrbanDigs that lets you enable it so you can see the most recent months. So I think listing discount right now, I'm actually going to go back really quick and check my chart. Listing discount right now is at 6%.
And explain what that's based on.
From original ask. We coded this from original ask, which is how I think. I mean, a lot of it's from last ask, but we did it from original ask. So now I expect, and again, this is April. Meaning like we had a 2-month delay. When August 1st hits, we published the May bar. I'm going to give you guys an option to publish May and June on this thing. It's going to be incomplete. It's going to change, but people are demanding it, so I'm going to give it to you, right? Where are those numbers? And I was telling people, now is about the time. Once you get into July, August, September, October, now is about the time when you're going to start to see it. So if listing discount trends start rising, just hear me out here. So we're at 6% now. Let's say that goes to 7, 7.5, 8, 9. This is as COVID deals start piling in, right? We see what happened in those deals in COVID. Now buyers are going to see that. Right? So now let's say it's 8 or 9%, right? And we're trying to explain to buyers where the market is today. Russ, my questions to you are, is the market shut down right now?
No.
Are you able to show property right now, even though you're restricted?
Yes.
Okay. Those are fear levels today near what fear levels were in March, April, May?
Near-ish, but it's not the same.
Okay. I would agree. There's still fear out there, but the stock market's not in the depths of hell, and you don't have that kind of hanging on you. So I think we're fearful, yes, but not nearly as fearful as we were back then.
Agreed.
Okay. Those 3 things, all right, that we just mentioned, makes today's market quite different from, again, if you were a buyer in April or May, you're buying sight unseen, or at least you're supposed to, sight unseen when fear levels are higher. And again, you can't see this place. All right. And an agent can't show. So now you're about to see what the discounts were in that time.
Yes.
Okay. See where I'm going with? So if the discounts were 8% or 9% during the shutdown, what should the discount be today when the shutdown's we're not shut down? You can view property, but yes, the other forces are still there. Probably not as much is my answer. Not as much. Certainly not higher, I don't think. I mean, the market may deem that the case, but I would think if you're buying during the shutdown at a higher level of fear, I would think those discounts, that's like the bottom watermark. That's the low level watermark. You know what I'm saying?
Right. But the first thing you referenced here, though, was a listing discount. And now we're talking about an actual discount from the last listing price.
No. This is all listing discount from original ask. This is a listing discount from original house. I'm not changing the statistic or methodology. I'm using it consistently. I'm just looking at the reading of listing discount, which is at 6% right now, meaning there's a 6% negotiability. If I look at all the sales data that's coming in and I put it all together in one bucket and I look at the median of that whole thing, which is a good way of looking at it, buyers are basically paying 94% of the original asking price. So it's $1 million property. They're bidding $940. This is, again, pre-COVID levels.
Assuming that they're then closing at the new asking price.
Property's listed for $1 million right now, but day one, $1 million. Okay, and then they cut the price $30,000 to $970, and then they cut the price $20,000 to $950, and then it closes at $950.
Yeah.
Okay. If you do a listing discount from last ask, that's going to be sold at full ask, because it's $950 ask and it's sold at $950. If you do listing discount from original ask like UrbanDigs does, we're going to have a listing discount of 5%.
Got it.
So now, which one's correct?
Well, you're basing it on a closed price.
What's that?
You're basing it on a closed price.
Closed price. Verified, closed, accurate. This is what the buyer bid, closed, contract signed, and closed on. Right? I'm not looking at anything else but closed, verified, accurate sales. The question is, what do we compare it to the last asking price, or do I compare it to the original asking price? Right? And there's a lot of messed up data in RevNy's RLS. It's a lot of messed up data. It's not RevNy's fault. It's just the fact that there's so many weird things from systems and processes that it's hard. Trust me, I lost all my hair to this. It's hard to fix those things, to go and say listing discount from original ask, because there's a lot of messed up things that cause problems. Now, we fixed a lot of that. We fixed like 95% of it.
I feel like to get a real interpretation of what that is, I feel like it's got to be the February 15th asking price to what it closed at, to see really what the discount is.
Yeah, you might have to do that. And if I look at January and February closings and listing discounts, it's at 4.7 and 4.9. So and now it's at 6. Again, my point is, I expect this to rise as COVID comes through. I expect the listing discount. It's basically full negotiability. What is full negotiability? Yeah. Listing discount from last ask is not full negotiability. It's just what the last ask. Where were they last asking? Where's the bid? It's partial of it. It's not representative of where this thing originally was priced and how far they brought it down in price reduction. We're trying to capture that to give the whole full picture. If this rises to 9 or 10%, what are buyers today going to think? Now, if I'm a buyer and I'm bidding down 15%, hear me out, today, right? So it's $1 million property. I'm bidding $850. Now the listing discount comes in at minus 10%, okay? And I'm trying to explain to this buyer, listen, buyer, that listing discount of down 10% is representative of the COVID market. So even in the COVID market, you weren't seeing a mass median of 15% deals. Now it's the post-COVID open market. It's a different scenario. Technically, the market's not as bad right now. I mean, it's not saying it's not bad, but it's not as pressured and challenging because of the reasons we discussed. You could see property. We're not mandated to be shut down. Big difference. Before you did, right? I think those were more negative forces. Before, the stock market was at the depths of hell. I think that had more negative forces. We don't have that today, right? So if the listing discount's at 10% for COVID deals and your buyer's bidding down 15%, you have an argument to say today's market is probably more in your favor than this number showing. I think you're more validated. If you can get this for 10%, that means you're basically getting the COVID discount after the opening. You know what I'm saying? That's all I'm saying.
100%. 100%. I think the mindset of the buyer is different than that, though. Like, in having many of these conversations, I think it's like, okay, well, that's great that happened. I'm shocked that the discount was only 10%. To me, it felt like it should have been more.
I'll tell you why. Because and we've talked about this ad nauseum on our weekly report since the beginning. The reason was because not every seller has to sell. That was the reason. And if there was a mass exodus and everyone wanted out, you would have seen thousands and thousands of COVID deals, because you would have seen thousands and thousands of sellers hitting bids down 15, 20, and 25%. How many bids were put out during March, April, May, and June during shutdown that were not accepted or entertained? And I got to think a ton.
Yeah, I wish there was a way to figure that out.
Just anecdotally, from talking to people, I had agents telling me, listen, I keep telling them that they got a good deal, but my buyers keep putting bids in down 15, 20%, and I'm able to get them 10. I could get them 9, 10, 11, but I can't get them 20, and they're just, it's not happening. How many? A lot of those. So that tells you not every seller had to sell. The ones that did, again, and unfortunately in March, April market, the spread between bid ask was wider. I mean, it's probably wide today, but not as wide as it was back then because of the more deflationary forces we mentioned. And the seller had a big decision to make. Do I hit that bid down 20, 25%? So now you're going to see some deals, outliers, extremes, out of not many. If we look at how many COVID deals there was like 600. 600 COVID deals, something like 600, 650, when they're usually over that time frame is 4,000.
Yeah.
So deal volume was just down 80-something%, which tells you that sellers were not participating in where the market was here because it's all about the bids. So what's the market worth? The market's worth down 20, down 25, down 30. Who knows? Are sellers participating? No. Are some sellers? Yes. Now, out of those 600, how many were gap down bids? Who knows? Maybe 30, maybe 50, maybe 60. How much are the majority of them? Most of them are under 2 million. And some of them are going to be 5%. Some of them are going to be 8%. I mean, I'm looking at them right now. I'm looking at sales on UrbanDigs every single day. I'm looking at the most recent sales every single day. And the number that I'm looking at is listing discount. And every day I look, there's more things that are less than 10% down than there are than more than 10% down. Way more.
Wow.
Which is interesting.
So I want to conclude with an idea for you to mull over. And remember, a lot of the people that are going to be watching this, that I'm going to send this to, are buyers, they're sellers, they're observers of the market. Sure, there are some brokers. A lot of out-of-town brokers actually watch this as well.
Right.
So the New York City market started to turn a corner in January of this year, right? And then COVID happened.
Yeah, I would even say a little. I would say like November, but yes.
So where do you think we would have been had COVID never happened right now?
Oh, I think we would have been, because I think we would have been on a great road to recovery, quite frankly. I don't think the stock market would have done what it did. I don't think the Fed and fiscal would have done what they did, which I think is going to have consequences down the road. There's never a free lunch. And the trajectory was clearly recovery. And the fact, I like to look at where we came from before I look like you don't know where you are unless you know where you came from. So if you think about where we came from, 2014 and 15 was the peak. 2016, 17, 18, and 19 were progressive declining months, the progressive deflationary environment for not a cliff fall, but a progressive slow drip kind of thing. And it was a policy driven thing. There was policy changes that impacted how investors and other people, affordability, and that made prices kind of come down to a new level. We were starting to bottom and come out of that for November, December, and January into February before this all started. I think there's no reason to think that trend would not have continued if this didn't happen. Yeah. So you're seeing a market today, if you think long term, that was already down, Russ. Like, I mean, we were down, I like to say somewhere between 10 and 15%. The lower end, maybe 10%, the higher end, maybe more 15% with outliers.
Just to clarify that, you're saying we're down 10 to 15% from the 14, 15 highs.
Yes. It wasn't a cliff fall, but with caveats. The new development market, the luxury price point markets, those were obviously doing their own thing, and they were down notably more, right? There was a high end. But for the majority of the market, it was like 10 to 15% over a four-year period of decline. It wasn't a big thing. And then COVID happened. We started to come back. Like, if I was a buyer and I saw a market that was declining for 4 years, bottoming, and then starting to come back, that was exactly where we were in February.
Right.
You know, and then COVID happened. Before we had a chance to reflate it all, another 10% down or whatever it is.
Awesome. Well, Noah, as always, your insights are amazing. I really appreciate you joining us today. Noah Rosenblatt with UrbanDigs. Remember, if there's any information that you'd like to learn more about, please contact us at info@focusreg.com. Subscribe to our YouTube channel and follow us on Instagram. Thanks again, Noah.
Thanks for having me, Russ.
All right, bud.
Take care.